In this segment, we're going to talk about how to record dividends. So the reason an individual would purchase shares of stock is for two reasons. One is because they hope to buy low and sell high, so they hope the stock price goes up in value over time. And the other reason is to receive dividends. Some investors prefer to buy stocks that pay little or no dividends because that means the company is growing and reinvesting the money into the business to improve future earnings potential, which in turn will increase stock price. Wealthy investors in high tax brackets prefer to receive a return in the form of higher stock prices because the capital gains are generally taxed lower than dividend income. Other investors, such as retired people, want a steady income. They may enjoy stocks that pay out a substantial amount of their income in the form of dividends, so they get that cash out and they can use it for their day-to-day financial needs. Analysts compute dividend yield ratios to evaluate a company's dividend policy. Basically, the higher the dividend yield ratio is, the more dividends that are being paid out to the owners. We're not going to go through the calculation of the dividend yield ratio. All you really need to understand is the dividend yield ratio. The higher it is, the better it is. The better return the investor is getting on their investment. So you need to understand three very important dates when it comes to dividends. There's the declaration date, the date of record, and the date of payment. Remember, dividends are not required, so they're not expenses. However, once the board of directors declares a dividend, it becomes an obligation. They can't take it back. So on the date of declaration, the board of directors approves a dividend. In this case, IBM declared a $1.387 million dividend. So on that date of declaration, an obligation is created for the business. So at that point, we have to record the dividend. So under A equals L plus E, where E is contributed capital and retained earnings, two things are happening at this point. Retained earnings is going to go down by the 1387 to record that dividend. And then our liability would go up 1387 because remember, we haven't paid it yet, but we've created an obligation to pay. So retained earnings goes down. You could also use a dividends account. So you can use the dividends account, which would later get closed into retained earnings. Companies can do either. They can debit retained earnings directly or debit dividends. And then you're crediting dividend payable at this point. In the real world, companies generally don't declare and pay the dividend on the same day because it would be too difficult to do that because you need to know who owns the shares in order to pay them a dividend. And you know, shares change hands each and every day on the stock market. So basically what happens is you have a date of declaration where the corporation promises to pay a certain amount of dividends, and then they record the liability for that at that date. Then you have the date of record, which is the date the stockholder has to own the shares in order to receive the dividend. So there's no journal entry required on the date of record. It's basically for bookkeeping purposes. The date of record determines who we send the checks to. So if you own the shares on the date of record, at the end of the day, on the date of record, you're going to receive the dividend. Even if you sell the shares the next day before the dividend is paid, because you own the shares on the date of record, you receive the dividend. So you have to own the shares on the date of record to receive the dividend payment. On the date of payment, all that happens is our liability goes away and our cash goes away. So when they pay it, our liability is going to go down by the 1387 and our cash is going to go down by the 1387. So to make that happen, we debit the liability and we credit cash. So on the payment date, notice equity isn't impacted at all. Equity is impacted when the board of directors declares the dividend and makes the promise to pay. Then all that happens on the date of payment is the cash goes away and the liability goes away. Retained earnings isn't impacted at that point. The date of record requires no journal entry. It's simply the date that you need to own the shares in order to be paid the dividend. The corporation needs to have sufficient retained earnings and cash in order to pay out a dividend. A lot of times corporations don't have enough cash, or they want to reinvest the cash back into the business, so they end up not paying out any dividends. That doesn't mean the company is a bad company or isn't financially successful. It just means the company's in the growth phase and they want to reinvest all of that money in the business to grow it. When a company reaches maturity, that's when they can start paying out large amounts of dividends to the owners, because they're no longer growing at an exponential rate. So they have excess cash that they can give back to the owners. Now we're going to talk about stock dividends and stock splits. So we said a little while ago that in order to pay out a dividend, a cash dividend at least, we needed enough retained earnings and cash to make that happen. Well, one option a company has, if they don't have enough cash but they do have retained earnings, is to give out a stock dividend. And what a stock dividend is a dividend paid with, you guessed it, shares of stock. So stock is distributed pro rata, which means if you own 10% of the outstanding shares of the company's stock, you'll get 10% of the dividend. So what that means is at the end, the stockholders have the same ownership percentage before and after the stock dividend is distributed. A stock dividend has no economic value. Basically what happens is, as additional shares are issued in the stock dividend, the market value of the shares goes down. So you end up with no more or less than you had to begin with. So you might say, well, what the hell? Why do I want a stock dividend if I'm an investor? Well, if the market price goes down, it makes the stock more attractive to new investors, which within the laws of supply and demand means that if demand goes up, that stock price will go back up. So in the end, in the long term, the stock dividend can result in the stock price going back up. And when it goes back up, you now have more shares of stock to benefit from that price increase. So as an example, if before the stock dividend you had 100 shares, after you have 200 shares, and the market value before is 20, after it's going to be 10. So before and after you have $200 worth of value. But if now after the stock dividend the stock price goes up $1, you now get a $200 benefit as opposed to a $100 benefit because you own more shares. So that's really the idea behind a stock dividend. It lowers the stock price, which seems counterintuitive, like why the hell would you want that? Well, as a current owner, I don't care if the stock price goes down. In this case, the stock price got cut in half, but I don't care because I still have $200 worth of value before and after. So what happens is after that, I hope that now that the value of the stock is lowered, entices more investors to purchase the stock, which will drive the stock price back up, and that's when current investors get their major benefits. There's two types of stock dividends, small and large. Stock dividends that are less than or equal to 20 to 25% are considered small. We're going to go with 20% to keep it easy. On the exam, there won't be anything in that range, 20 to 25. It'll be like a 10% versus a 50%. So it'll be very easy to differentiate if it's small or large. So a stock dividend that's less than or equal to 20%, we'll say, is recorded at market value. If it's more than 20%, then we're going to consider it a large stock dividend, and it's going to be recorded at par value. This is a rule by GAAP. Basically, GAAP has decided that if it's a small one, we can record it at market value. If it's a big one, we don't want the company to have to use up all of its retained earnings, so we allow them to record it at par value. I don't make up the rules, I just present them. Talk to FASB if you don't like it. The entry for a stock dividend is simply a transfer from one equity account to another. All we're doing is moving money from retained earnings to additional paid-in capital and common stock. That means that the net effect of a stock dividend is zero. So let's talk about how to record these. A large stock dividend, we said, is recorded at par. So when we record the entry, under A equals L plus E, all that's happening within equity is we're moving money from retained earnings to contributed capital. If it's a large stock dividend, then that means we record it at par. So that's going to come out to be $10 million in this case, 50 million times 20 cents. So what happens is retained earnings goes down by that 10 and contributed capital goes up. So the net effect to our equity is 0. So when we're recording a large stock dividend, we're going to take the number of shares times the par for our retained earnings and the number of shares times the par for our common stock. No additional paid-in capital is needed because we're recording the amount at the par value, so there is no additional amount. If it's a small stock dividend, then we record it at market value. So the overall impact to the accounting equation is similar in that we're moving money from retained earnings to contributed capital, but we're going to be moving it at the market value. So we're going to have, in this case, 5 million times the 150, which is 750 million. So we're going to take 750 million out of retained earnings and put it into contributed capital. So again, the net effect is 0. In our journal entry for retained earnings, it's going to be the number of shares times the market value is my debit to retained earnings. Common stock always is the number of shares times the par. And now because we're recording at market value, the market value and the par are different, so the difference goes to additional paid-in capital. Overall, our equity remains the same. We're taking $750 million out of retained earnings and moving it to contributed capital. If we weren't given the number of shares, in order to get the number of shares, so the number of new shares, we would take the number of shares that are currently outstanding and we would multiply it by the stock dividend percentage. So in the examples that we had here, we were given the number of new shares, the 50 million shares or the 5 million shares, but in a problem, if we're not given the number of shares, instead we're told that the shares outstanding are 1,000 and the stock dividend percentage is 10%, then the number of new shares would be 100. So really in my equations here, I should write number of new shares because that's what we're recording when we're recording a stock dividend. It's the number of new shares times either the par for a large stock dividend or the number of new shares times the market value for a small stock dividend. And to get the number of new shares, if you're not given the amount, you would calculate it by taking the number of shares that are outstanding times that stock dividend percentage. A company can also affect the number of shares that they have outstanding as well as the stock price by doing a stock split. The main difference is with a stock split, there's no journal entry. So no journal entry is recorded for a stock split. Instead, what happens is the number of shares and the par value both change. So in this case, we're doing a 2-for-1 split. So to figure out the shares after the split, we multiply by the stock split ratio, which in this case would be 2/1. And then to figure out the par after the split, we multiply by the reciprocal, which would be 1/2. And then you notice that before and after the split, the total par value, which is the amount in the common stock account, stays the same. 3,000 times 2 cents is 60. 6,000 times 1 cent is 60. This applies for any type of stock split. So if it was a 3-for-2 stock split, we would take the number of shares, 3/4/2. We'd multiply it by 3/2. And then the par, we would multiply by 2/3. So if we want to figure out what the number of shares are before and after the split and the par, we multiply by what I call the stock split ratio. If it's 2-for-1, it's 2/1. If it's 3-for-2, it's 3/2. If it's 5 For 3, it's 5 over 3. And then to figure out the par, you just flip the ratio and use the reciprocal. And when you're done, the number of shares times the par should be the same before and after the split. There is something called the reverse stock split. That's commonly used for penny stocks, where instead of a 2 for 1, you do like a 1 for 2, and you would calculate it exactly the same way. Basically, that's done to reduce the number of shares and therefore increase the market price of the stock. Investors are kind of weird. They like low prices, but not too low. So when it's too low, like penny stock, that gets people nervous. So a reverse split can entice more investors because it makes the stock look more stable if it has a higher value. If the value's too high, investors don't like that either. So a regular stock split, which would ultimately reduce the market price, makes the investment more appealing to owners. Bottom line, a stock split and a stock dividend has no net impact on equity. A stock split has no journal entry at all, whereas a stock dividend moves retained earnings into contributed capital. Still, the net effect is 0.